look. That's assets, good credit history, low DTI. Oh my gosh, I won mortgage bingo! Hi, welcome to the Red Desk. If you're visiting today, that can really mean only one thing. You're looking to buy a house. That's so exciting! Whew, sorry, I just get so excited for first-time home buyers. Today's about mortgage qualification. In other words, what the heck do I have to do to get a house? Qualifying for a mortgage just means being trusted enough by a lender. If you've run some numbers and are like, yeah, I can totally pay for a mortgage, then all you have to do is prove it to lenders. There are certain things lenders always look at, which we'll get into in a second. But first, remember there is no perfect number or exact answer to what makes someone qualified. For example, if I'm making $15,000 a year living my best life drawing pictures of frogs in cool costumes, then it might not look like I'm able to afford a house. But what if I'm also sitting on $200,000 in assets? Like, say I'm willing to sell my great-granduncle's world-famous stamp collection to fund a down payment. Maybe that would change the game, right? Frogs and stamps aside, here's what lenders look at. Things like income. Lenders look at all your income, your take-home pay, your benefits, your alimony, your overtime, your commissions, your bingo prizes. Well, not bingo prizes. The big thing lenders look for with income: consistency. That means if you're a freelancer or have a regular income, make sure you keep tight records. The type of property you want, that matters too. Primary residences are the easiest to qualify for. Second properties or investment properties have much higher requirements. If times get tough, people are most likely to keep paying the mortgage on the house they actually live in. Also, not all lenders offer financing for certain property types, such as mobile homes or condos. So be sure that the type of home you're looking at can be financed. Assets are anything outside of income that can be liquidated or sold to cover expenses. Assets include things like checking and savings accounts, retirement accounts, things you could easily liquidate if you needed cash. High credit scores mean you pay your bills on time and are financially responsible. Low ones usually mean you've missed payments or done something to make creditors suspicious. That's why lenders care. There are no broad credit score floors since lenders look at a bunch of factors. But anything under a 500 is tough business. DTI stands for debt to income ratio, which is exactly what it sounds like. Every month, how much of that cash that's coming in the door is already spoken for? Bring home $4,000 and $2,800 goes to bills and existing debt? That's 70% and pretty high. Most lenders want at least 50% or lower, and the lower, the better. Some other things to keep in mind are whether you have to pay for PMI, private mortgage insurance. This is a fee added to your monthly mortgage payment when you have less than 20% equity in your home on a conventional mortgage, if you have cash on hand for closing costs, and if you have an emergency fund handy when something unexpected occurs. Everything is on the table, and your underwriter has the final say. It's no fun getting into an application process and then realizing you never had a shot at qualifying to begin with. You should start by calculating a rough mortgage payment based on what you see in the area you want to buy in, and get a general idea of what is feasible, not forgetting to take into consideration things like taxes and insurance. Then, talk to a few lenders about any details and requirements before spending too much time with them. If the numbers don't look good or you receive a denial from a lender, there are some things you can do to boost your chances of being approved, like improving your credit, making payments on time, lowering your total debt, avoiding hard credit pulls. These are all ways to raise your score. We have a whole video on that you can jump into. We dropped the link in the description. Can you reduce any monthly payments? Pay off high interest debt? Brainstorm ways to reduce the amount of money going out each month and lower your DTI. it can make a big difference. A bigger down payment means a lower loan amount, which means less risk for the lender. The more you can save, the better your case. FHA, VA, and USDA loans were created to help people get into houses. If you're denied a conventional loan, see if you're eligible for any of these options. Rocket Mortgage doesn't offer USDA loans as of 2023, but they do offer FHA and VA. If signing with someone is in your cards and they have better finances than you, then that may be your ticket in. Keep in mind, that is a huge decision for both people involved and should be taken slowly and seriously. It stinks to look at your finances and realize you can't afford something, but better that than being house poor at a house you can't afford. If you're ready for a house but you're denied, don't get too down on yourself. Make an action plan to decrease your DTI and raise your credit score, and try to think of it as part of the overall process. With patience, strategy, and perseverance, you'll get one. Rocket Mortgage has an awesome mortgage calculator where you can start plugging in numbers. Keep in mind that these are just estimates, so go calculate away. See you next time. Thanks for checking us out. If you'd like to see more videos just like this, you can click right here. And don't forget to like and subscribe. See you next time.